Hey traders, it's Stephen Brooks, and today we're going to be talking about the most under-discussed topic when it comes to trading, and that is specifically liquidity. There are very few things in the market that you actually have control over. You don't really have control over what might go on in the market. If there is a virus going on in Asia, you don't have control over what the CEO does. If he decides to invest in the company, buy back stock, or buy another company, you have no control over that whatsoever. One of the things that you have control over is which stocks or which options you trade in and out of. Liquidity is so important. I think before anyone gets any ideas of which stocks to buy and when, or which trades to make, they need to learn what a crash course in liquidity is, and we're going to talk about that today. When we are sitting there trading, at least the way I do it, I don't like to sit in front of my monitor all day, every day. I have a life to live, okay? I have a cat, I have a dog, I have a fiance. I don't want to sit all day in front of the screen just trading. I don't want to do that. What I want to do is I want to place my order. I want to get filled like that, and then I'm going to walk away. How do we determine if that is a possibility or not? It comes back to the idea of liquidity. We want to trade in the markets, whether they're stocks or options, where there is demand for our trades. If there is the more demand there is for our trades, the quicker we're going to get filled at the best price possible at any amount of size that we want. I want to trade in only those names, and you should only as well. So the names that we look at in terms of what stocks or which options have the liquidity is, we want to make sure that the stock has over 1 million shares traded on average over the last, let's say, 30 days or so. If you're trading one of these very obscure biotech stocks that have like 10,000 shares, like some days I trade more than 10,000 shares and I don't have gazillions of dollars. That means that if you want to trade one of these biotech, one of these, weird stocks that you think might explode, but it has like 100,000 shares or 200,000 shares, like there is no demand for whatever trade you want to make. And because of that, you're going to fill at a horrible price, and you're not necessarily going to get filled at the size you want. On top of that, not only do we look for about 1 million shares traded on average over the last 30 days, we want to make sure that every single one of these stocks that we're trading has both monthly and weekly options. This is very, very important. Again, why is this important? Well, we want to trade in the marketplaces that have demand for what we are trying to do. That means we can get filled very fast at the size we want at any time that we want. If a stock has monthly and weekly options, that means there is so much demand to trade options in a given stock that they are forced to go ahead and offer weekly options. Every single stock out of the box, they get these monthly options contracts, but if there's so much demand for more availability for these contracts, they'll bump it over to weeklies too. So we want to see $1 million shares traded in total on average for about a 30-day period. We want to make sure that the stock is trading both monthly and weekly options, and we want to make sure that the bid and the ask spreads are pretty tight. And what we say for tight is less than 7 cents. So less than 7 cents. Now, why do we do this? Well, again, there's so many things in the market that are completely out of your control. Liquidity, and when the stocks you choose to trade in and the options that you choose to trade, you have 100% control over. So let's say, as an example, you are someone that trades one options contract a day, and you do it for a year. So in total, that's about 252 trades for the year. And let's say you're one of those folks, and I've seen way too many of these people out there, but let's say you're one of those folks who loves to trade these really obscure stocks that I've never heard of and nobody's ever heard of. And the problem is, every single time you try to place one of those trades, you have to pay more than the mid price or fair market value, let's say by about 3 cents. Now, if any of you have ever traded before, you know this is absolutely a reality. This is absolutely a reality. That means you are taking a loss of $3 per every single trade that you make, which does not factor in things like commissions. This used to be a lot worse because commissions were a flat fee plus a price per contract. Now it's a lot better, but this used to be a lot worse. It's still not that good. So over the course of a year, if we take 252 trades and we lose $3 per trade, that's a $750 hole. If I can get my red pen, that's a $750 hole before we've even determined if any of our trades are even right. Now, this is something that is horrible. If you're one of those folks that's only trading one contract, there's no way you probably have more than $10,000 in your account. If that's true, at the beginning of every single year, just take 7.5% off the total value of your portfolio, because that's what's going to happen if you don't trade in these liquid products. However, if you do trade in these liquid products, again, you can get filled at the price you want, at the size you want, at any time you want, okay? So the funny thing is, everyone says there's these thousands and thousands of stocks out there on a given day, but the truth is, there's only about 180 that fit the criteria of having a very tight and bid-ask spread, that fit the criteria of having both weekly and monthly options, and fit the criteria of having about $1 million a share on average traded over the last 30 days. Again, there are so many things that are out of your control. I cannot stress this enough when it comes to trading. You can always choose what you actually trade. I don't know about you, but I would never, ever, ever choose consciously, willingly to place a trade where I had to take a loss just to enter the trade. I don't care how good of a trade you think it is. There's no way on earth I would take a loss just to enter the trade. And again, very simple example. If you have a $10,000 account, you're probably only going to be able to trade one contract. If you're one of those traders out there that loves these obscure biotechs that might explode, might not, they don't have the participation that you need to get filled at the price you want, at fair market value, and the time you want. Because of that, you will have to take a loss just to enter the damn position. And I've never seen a trade that was so good where taking a loss just to enter the trade was acceptable. Because again, if you take a 3 cents or $3 per contract loss just to enter the position, that's only to get into the position. If you stack that with the fact that you might have to take $750 loss on the total year, that's 252 trades out of the year, a $3 loss just to enter the position. If you need to take a $3 loss just to exit the position, now you're looking at $1,500 just to trade. That is not even including commissions. So at the end of the day, I would like the folks out there to stop worrying about all these ridiculous small price penny stocks, low volume, because the truth is, if it would have millions of shares traded if an institution or a hedge fund or endowment fund cared at all. Because they don't, the market makers widen out those markets and they absolutely screw, because they have to and they can, every single one of you out there that trades these ridiculous names and trades these ridiculous options. So if I can give you one piece of advice at all that you learn from me, rather than, oh, this Fibonacci or this trend line, it's focus on the most liquid names, because you don't want to take a loss just to enter the trade. If you plan on being a trader or an investor for a substantial amount of time, you might say, oh, losing 3 cents here or there is not a big deal. But when you do it thousands of times over the course of your trading career or your investing career or your life, that's going to end up being a big loss. Again, very simple example that we've gone over. If you take 252 trades in a year, that's one per trading day a year, and you trade one options contract on each of those days. So that's it. Very low barrier to do that. You trade one of these illiquid names, one of these ridiculous biotechs that has some news coming out like 3 years from now. You do that. If you take a 3 cent loss just to enter the position on every one of those contracts, which is incredibly realistic, that's $750 loss just to enter the position over the course of a year. And then if you want to get out of those positions, you're going to have to take, again, a 3 cent loss just to exit those positions over the course of a year, another $750 loss. You can control very few things in the market. One of the things you can control is, am I trading the most liquid products? If you're not, you need to start doing this immediately, because no one in their right mind should ever have to take a loss just to enter the position. Folks, please Take this to heart. I'll see you all in the next video.